Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll give you my opinions as we go through it. It'll be related to a couple of topics, generally commodities, financial, and or wealth building topics. So let's dive right in and see what people are talking about on social media. If you want to follow me at Finding_Finance, and if you want to join our community, we do have a question and answer session happening today, 5 p.m. Mountain Standard Time, and I can help answer your guys' questions. I can't do anything one-on-one. I can show you what I'm doing. It's all on the website. I'll let you guys know where to find that stuff on the website if you just joined, and we can talk about everything that is coming up. So, Nugget Capital Partners says pure play commodity investors, always a shortage, always manipulated markets, generally always believers in high inflation, always government skeptics, always hostile towards opposing views. What else? Well, I think right now I am a pure play commodity investor. I'm also in the equities and stuff like that. The only reason I'm there is because of some of the things that you have stated here. There are shortages or deficits in the market. I do believe in high inflation, and I'm not hostile to opposing views. But right now, we are also incredibly cheap for commodities. So it's the main drivers of what pushes me to commodities and why everyone should be massively bullish on commodities coming up is because of where we're at in the business cycle. And what I've seen with non-commodity investors is they don't know anything about the business cycle. They don't know anything about the real estate cycle, and that's where there's a gap. So the people who don't know about the business cycle are probably going to say that you should go into some index, put it in the S&P 500, which is incredibly overvalued, and put your money there and forget about it. And that they don't worry about market fluctuations and that they will continue to invest in it and cost average in. That's the word that they always use, cost average into it. Um, what I see and what my opinions are is someone who does not get excited over commodities is someone who doesn't follow the market. We've got decades that are about to happen, decades upon decades of returns that are going to happen in years. You can invest like an all-star, get absolute ridiculous returns in a short period of time, and this time only comes about during an expansion phase of real estate, during a credit expansion phase, and on top of this, we have some pretty big underinvestment that's occurred in the commodity markets. We're also starting from all-time lows. We're talking all-time lows of commodity to stock ratios. So I find it weird that I don't know why someone would post this pure play commodity investors. The downside here is the volatility. The volatility is tremendous, but the volatility is what gives you the upside. That's what gives you the 10x, 20x, 30x. You can't have that without volatility. If you're going to get 10 or 20% up days in a single day, you have to have the volatility to do it. So I'm very much pro commodities, and right now I just don't see where the value is outside of commodities and precious metals. I mean, obviously there's value in emerging markets, obviously, but that's also just more so a commodity play. So the markets should be played with the cycle that is in cycle. And the cycle, which is secular, secular with an S, not cyclical with a C, uh, those trends last for many years. So when you post this, those trends last for a decade plus. There's always going to be a shortage until the shortage is met. And I'm not talking about manipulated markets, but yeah, there's high inflation during this secular trend. And I mean, we're all supposed to be government skeptics. I mean, I don't know how to answer that. And then I'm not hostile towards opposing views. I just want to know what your view is and what makes you think it would be a better investment than commodities. That's all. Gold, as relevant as it was back in 2018, he's got a couple of big moves. I actually think this is what's coming. I do think price is going to go up. Obviously, it's going to cycle up, but we're in a secular bull market. It started in 2016. That was the beginning of the secular bull market. We had a nice entry point in 2020 where commodities to stock ratio bottomed out and started to move on up. And that's where I got very bullish in commodities and where I am allocating the majority of my wealth towards commodities at this point. But great chart here. Major freeze-offs already happening before Texas even gets cold. This means production will likely fall down to 70 billion cubic feet range when it actually gets cold. Last week was just a warm-up for what's to come. That's for nat gas. And I've got some other information below here. We've seen some ridiculous pricing moves up in Alberta. I am it's ridiculous, guys. I don't think I've ever seen the natural gas price move that fast. I'll show you what it looks like. The average age of the world's 14 largest supergiant oil fields is now 66 years. The world's giant oil fields by Matt Simmons. Matt Simmons was an oil analyst. He talked a lot about the Middle East. He was a peak oil guy in the mid 2000s. Said that these oil fields were getting pretty old. He did not see the shale patch coming. The shale patch was the majority of the growth since the mid to late 2000s, and yeah, I followed him back in the 2000s. How much should a 40 or 45-year-old male in good health be able to bench press? How fast should they be able to run a mile? How many pull-ups? How long a fast without any problems? Well, that's how I'm 42. I'm right kind of smack dab in the middle of that. Um, my standards are, I want to be able to do at least 60 push-ups in 60 seconds, which I can do. But that's my standard. I should be able to run a mile under 7 minutes. And then for pull-ups, I would say anything above five strict pull-ups, I would say is pretty good for a 40 to 45-year-old male. I'd like to be over 10. That's where I'd like to hold the line. But for a good health male, like push-ups or bench press, I would say anything over 30 push-ups. A mile under 8 minutes would be acceptable, and then over five pull-ups, I think would be a very good one. And I'm sure the majority of people cannot do any of that. But if you can do all that, I think you've got you're set up pretty good. The key to this commodity super cycle is supply under investment and disruption, not demand. I start with the principle that I want to be as close to the physical as possible. Equities will not give people the torque they grew to expect in the 2000s cycle, again, with exceptions. So that's his opinion, but my opinion differs actually quite, mine differs a lot from that. So what I would say is if his premise is right, where the super cycle is driven off supply under investment, I would actually not go towards the physical. Um, that's a safer play. What I would do is I would go after the things where they're going to put over investment to correct the supply problem. So I think the picks and shovels, the energy service companies, are a really good spot to be. You could have prices go up, but I think that will benefit the day rates and stuff like that. I also think that companies that can grow production rapidly, that have infrastructure already in place, if it is a supply problem, I think that if they can ramp it in the right market conditions, I think they're going to make ludicrous amounts of money. Companies up in Canada that have drilling capacity they've got room to grow. They can double production by 2026, 2027, 2028, 2029. I'm all bullish on those guys. I've got a ton of companies that if you guys, I mean, come to the question and answer session, ask me about those companies, guys. I have no problem sharing all those companies and how bullish I am on all of those things. But I think holding some of the commodities, yes, that's a low risk way, but I think that there's the biggest opportunity of a lifetime in investing in the companies that can grow production at a time when production will be pretty bleak. It's going to be tough to grow production. So those that can grow are going to get massive margins, especially those that aren't making a lot of money today. They are swing producers, they're high cost producers, and I see that setup just being absolutely phenomenal. Phenomenal setup. Like I think this setup is going to crush the 2000s. The 2000s was just a credit expansion at the back end of an expansion phase of real estate. And the demand is from the credit expansion. We are at the same spot for the credit expansion. The demand will be there, but the supply won't be. And the supply, if you can invest in the small mid cap companies that can grow supply at this juncture, they're going to go ballistic. So the big boys, I think, will be rough. It's going to be rough waters for the big, maybe like the Exxon Mobil's or whatnot. It's going to be tough for them to grow production, or maybe I chose the wrong company. But some of the bigger companies that maybe don't have the pipeline of growth. So that's what I'll say there. M2 money supply is contracting for the first time since the 1930s. Now, these guys are just looking at charts and they're trying to draw conclusions. So what I'll say here is the Great Depression, I know they're comparing it to the Great Depression, and they're saying, look at the level that it's at. It's not what you want to do. What you want to do is you want to say, why did this go down? Why did this go down? In the 1920s and 30s, we had a gigantic real estate bubble in the 1920s. It was so bad that the deleveraging on the back end of that destroyed the banking system. So this here brought it down in this period from the real estate market being inflationary in the 1920s and then basically crashing the whole system. It was much like that in 2008 as well. It was a deleveraging event from the real estate market. We are not in the same area as that. This was done on purpose, and it was during the strongest portion of the real estate cycle. So there could be a slowdown, yes, but I don't think it's going to be anything like a Great Depression, at least not yet. We've got a lot of homes to build, and you don't build homes and you don't extend credit in a Great Depression. That is a bull market. That's the end. That's the back half of the real estate cycle called the expansion phase. We have to first go into the hyper supply phase where the inventory grows, and then we get our crash. But that's probably late 2020s, maybe even early 2030s. I don't know the exact timing. We have to see how fast we build homes. We have to see where interest rates go. There's a lot of things that have to occur before that. But keep in mind also that this was a synthetic move in M2 money supply. So they're yanking it out, and then I think they're going to try to slowly bring this all together, where we get the real estate expansion phase, and then the phase out of stimulus inflation. So they phase out the stimulus inflation, and then they phase in inflation from the expansionary phase of real estate. Now, this is crazy here, guys. I saw this chart and I was like, is this real? Are you serious? And I went to the website and it is real. It says reality sets in. Natural gas prices can be extremely volatile on the smallest shortage or surplus. If this persists for a few weeks, BIR's unhedged approach will pay off handsomely. And there's other companies that are partially hedged or very much exposed to the um, spot price of natural gas. But look, guys, look at this. This is $1.75 January 1st. This is $14 January 12th. That is an 8x in terms of pricing in 11 days. 11 days, 8x in pricing. Do you know what this is going to do to the natural gas producers in Canada that are unhedged? You know how much drilling activity is going to come and what the drillers are potentially going to do up there? And you know what? I am positioned for this. I am ready to take full advantage of this 8x in pricing of Alberta natural gas. ACO, baby. Coming on down, the soft landing crowd is acting very smug. The leading and lagging ratio peaked 25 months ago. Add 25 months to February 1998, and that is the March 2000 NASDAQ peak. Add 25 months to December of 2004, and that's January 2007. The Bernanke subprime contained speech was March 2007. So we still have a lot of people that are worried about the leading indicators potentially saying that there's going to be a recession. What I'll say is, I mean, if you look at the way that this has fallen, you usually get a recession where these things have fallen. So they fall, recession, fall, recession. I get it. We would have already been in a recession. If you look at kind of where we're at today, wouldn't this already indicate that we're already in a recession? And when this turns, we'll be coming out of it. So indicators that lead the economy is recovering. We haven't turned with the leading indicators yet, but we'll continue to monitor it. And I'll share whatever information I've got when this does come up. Doomberg thinks that natural gas liquids are going to replace oil, but 65% of natural gas liquids consumption is ethane. Ethane is not even a fuel. Its main use is to make baggies. So most natural gas liquids production and consumption is ethane, which is not even a fuel, but is used to make baggies and other plastics. So I don't know. I'm not trying to interject myself into this mix, but I think it's a little bit of a stretch to maybe add NGLs as part of fuel. And then we've got a U.S. recession. Okay, I've already went over that before. That was the last one. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys want to hit up the Sunday question and answer session that we're having today. We will be talking about a lot of the companies and the opportunities that are out there. I might start it with something with somebody who mentioned, you know, but finally some things are clicking for him, and I kind of want to go over that portion of it. I don't want to dive into it here, but we'll talk about it at the question and answer session. All right, guys, catch you later. This is Finding Value.